here to tell us all about it. His name is Rod North, mate, from Bourse Communications. Good to see you.
How are you going, Peter? Good to see you.
Mate, tell us about your company.
Bourse Communications is an investor relations company, so what we do is we look after a lot of listed companies that have market capitalisations of 300 million or less. And of course, in the last sort of year or two, a number of those market caps have dropped quite substantially because we've seen very significant decline in the market from October, November 2007. But of course, the interesting thing is this year we've seen the market move up quite substantially from its low point in March, and I don't think a lot of people realise that we're probably actually in recovery at the moment as opposed to the recessionary phase.
Okay, well that's a good issue that I want to get to you on in a moment. So you represent a lot of small cap companies. How have they done in the recovery since March?
We've started to see a few of these companies get out into the market and tell their story, and we've found that I think through 2008 a lot of them got a bit gun shy and felt that maybe there isn't much of a reason to go out and tell our story to get new shareholders and talk to brokers and analysts and fund managers. But what we've found, particularly this year, when they've gone out, particularly companies that have been able to do some interesting things. I mean, we've had some companies in the mining and energy sector in particular that have made some pretty good announcements and done some pretty good deals. And of course, these things have been disclosed to the ASX, but don't always find their way back to shareholders and fund managers and investors. So we've been actively encouraging those companies get out and tell their story. And what's happened is that we've started to see some buying come back into those stocks. A lot of the companies have been largely illiquid as well. Because the market declined so substantially, a lot of their share prices dropped down to historically sort of low levels, but didn't necessarily reflect the value in those companies.
So there's going to be a lot of good value once the market believes that the worst is definitely behind us.
Yes, I think that's right, and I think if you apply the usual practices and principles of assessing companies and their management and the sector they're in and their cash position and their ability to grow those businesses into a recovery, I think they're probably going to be the sort of standout companies that investors are going to benefit in investing in over the next 6 to 12 months.
Well, you might have heard me talking to James Dunn early. James, a little bit of a doubter, not sure whether we're in the recovery phase, thinks that America will see a bit of bad news, particularly on the unemployment front. Why don't we go to your investment clock and we'll talk about where you think maybe the US economy and where the Australian economy is in relation to your investment clock, and we'll try and work out what our best play should be. So here it is.
Well, when we look at the clock at the moment, I mean, the interesting thing is that, just to go back in history a bit to October, November 2007, we were really positioned at that point between 11 and 12. And what's happened in the 20 months since that time, we've moved right through the slowdown phase and through the recession phase. Now, that's particularly interesting because most people don't actually realise that we've really been through the recession, as defined by the investment clock, which had its reference points back in 1937 when it first appeared in the Evening Standard in London. But interestingly enough, if you look at, we've seen in particular interest rates through 7 fall substantially because the cash rate has fallen from 7.25% to its current rate of 3%, the Reserve Bank cash rate. And we've started to see share prices rise again from a low point in March when our All Ordinaries Index got down to 3,109. So, I'm prepared to actually say we are in the recovery phase.
Are we past 7 or between 6 and 7?
I think we're past 7. Interestingly enough, the Reserve Bank's got a little bit up its sleeve because at the official cash rate of 3%, there is room to move if the economy sort of turns further down over the next 6 to 12 months. And I mean, one of the key indicators will be what happens to unemployment. We're currently at 5.9%, and that figure, of course, is under pressure to go higher, and that may actually force the government and the Reserve Bank to look at both further fiscal measures and monetary measures.
I think the point you should make about this as well, that even though the chart is divided up evenly, there's no reason why a slowdown might only go from 1 to 2 and a recession might go to 2 to 4 and the recovery could run effectively from 5 to 9. Is that?
Yeah, I think that's a fair summation of it. I mean, the clock itself, I mean, is a reference point for people to guide them. And I mean, one of the biggest problems I see people have, and over the last sort of 25 or 30 years that I've been involved involved in investments is they never quite know when we're at the bottom or when we're at the top. And that helps enormously, because it's generally when people read about the good news again on the front page of the paper, you know, we're back, you know, to between 11 and 12. That's right. Yeah, and it's trying to encourage people to look at the market now and take the benefits that can result from investing, you know, at a fairly low point.
Yeah. OK, what about the book you've written? Tell us about the book.
Yes, well, the book has sort of evolved out of a lot of interest in this investment clock.
Is it here, is it?
And that's it there.
Understanding the investment clock.
Your Road to Recovery, that's the one. Yeah. And, you know, we managed to get a clock on the front of it, so people can actually stand that up in the corner of the room and move the dial around. And what I really want people to do with that is use that as a reference point and go and talk to their financial advisors and say to them, OK, what should we be doing now in this stage of the cycle? Don't wait another year. I mean, it's been interesting that a lot of people have said, I stopped contributing to super a year ago because I worried the share market might go down further. Well, what's happening now is as the market's gradually increasing, and we've seen the market move up in the last 2 days 5%, they're going to miss out on that opportunity, particularly with shares. And the historical reference points there are that over 109 years of, say, the All Ordinaries Index, the market has always eventually come back to that high point. And in the case of our market, that was 6,800 back in October, November 2007.
Okay.
A low point of 3,109 in March this year. So there's a lot of potential to regain that territory. And normally that happens sort of over a 33-month period from the low point.
Yep. And the low point was March.
The low point was March, and we've had the market go through 4,000 in June, and we're very close today, back to that 4,000 mark. And I've got to say, a lot of people in the industry were probably a year ago thinking, gee, if we see 4,000 by the end of the calendar year, that would be surprising. But we're pretty much there, you know, at the end of the financial year and into the new financial year now.
But I guess one of the most important points from looking at stock markets over the years is that to try to time it is really hard. So really you should be making a regular commitment to really good stocks. And in a sense, if you had the guts to buy all these great companies we're talking about now on the Aussie stock market in October and November of last year, you might have a sinking feeling when the price went down. But looking at, say, by May of this year, you were laughing your head off and popping French champagne,
You've got
weren't you?
some very spectacular gains over that period, Peter, you're right. And I think that's where people have got to have a bit of nerve, but they do need to understand where they are in the cycle. And I think that's where a lot of people sort of don't fully appreciate, well, where are we in the cycle? Because often the business news that people are reading, particularly in print, doesn't always indicate that the time is to invest is now.
No, because they tend to concentrate on the short-term positions, don't they? They're not writing from a point of view of a long-term investor who may well be willing to take a bit of pain for 6 months on the basis that over the 3 or 4 years that follow, you'll be laughing all the way to the bank.
Exactly.
Which you might own as a share.
Well, that's right. And probably the banks are pretty outstanding if you look at the value there. And generally, as the market over history has increased in many of the booms and busts that we've seen, the banking sector and construction engineering sectors have been very significant gainers over that period as well.
We're running short of time, mate. Young people, what's your advice to them on the stock market?
Young people, particularly Gen Y, Gen Z, have been polarised by inaction over the last few years because they saw property market being too high, share market being too high. There's a really good opportunity for them now to get into shares, property, and get good advice and build a portfolio for the future.
Good advice, mate. Now, stay here because I've got a viewer question or two. You might want to share your insights on it. Now, to our viewer question from Rod, and he asks, why does our market move in conjunction with America's market? For example, why does BHP move in line with America's stock market, although most of its trade is with China? That's a good one for you to have a crack at.
It is a good one. Now, it's interesting because our market in some ways connects with the US and sometimes it doesn't. And often the American market is really indicating where things are 6 months ahead. And I certainly think that the US market is probably well ahead of us at the moment, and we're starting to see ourselves move, you know, more in line with where the US is at the moment. So, I mean, there are some seeds of recovery being sown in the US. I mean, we've started to see the reporting season of major companies, with a spectacular result from Goldman Sachs out today.
Yeah. Intel was pretty good too, wasn't it?
Intel was a good result, and then our reporting season starts